Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. It is Friday, February 6th, and you are tuned into the ChartFix. So today we're going to start off with a classic bearish reversal pattern that was confirmed for the NASDAQ 100 Equal Weight ETF, QQEW. Money is moving out of the NASDAQ 100, but still into parts of the S&P 500, a serious expansion of new highs this week. Low volatility stocks within the S&P 500 are holding up, and we'll see that 8 of the 11 equal weight sectors are up year to date. So the broader market is still doing okay. And then we'll look at some of the leaders. It's as old school as it gets. So we'll start off with QQEW because the point to make here is this is not just an issue with large cap tech stocks, say the Mag 7 or QQQ. It's also an issue throughout the NASDAQ 100. And if we look here at QQEW, we can see a double top taking shape from that October high to the highs here in December, January, and then you have intermittent support. And when you break that support level, that confirms the double top. So basically, this is a distribution. And to be fair, you only know it's a distribution in hindsight. Sure, you can look at volume-based indicators to decide if more money is moving in or out. But in reality, the trend is up until it isn't. And you can see here that basically you're moving sideways, and that means there's just a battle going on between the bulls and the bears, between buyers and sellers. And here, when you get this break below support, that means that supply selling pressure is overpowered demand. And so that's when you get the break. That's the straw that broke the bull's back, basically, because you've broken support. You've forged a lower low, and that shows a material increase in selling pressure. So the trend is reversed for QQEW. If you look back in 2025 early, you can see in March we had a big support break. Wasn't really a double top because you had a higher high there, but you clearly had a support break, and then you plunged. And if you look at the indicator window, I've got the PPO 5200, which measures the percentage difference between the 5-day EMA and the 200-day EMA. And it turned negative there the second week of March as you broke support. And then it turned positive there in early May to signal an uptrend. And if we go down to the indicator again, you can see it turn negative this week to signal a downtrend. So we have a downtrend working in QQEW. Now, if you look over here in March 2025, you had this sharp decline, then you had a counter trend bounce, and then another decline. So currently we're oversold. We could get a counter trend bounce at some point, but watch out if you get some sort of rising flag or wedge and then a break, that could signal a continuation lower. So we clearly have issues within the NASDAQ 100, but I don't see many issues within the S&P 500. In fact, au contraire, because if you look here, you can see that new highs expanded this week. We had 100 new 52-week highs within the S&P 500. That's 20% of the S&P 500 hitting a 52-week high. And this indicator has always been bullish. You can see it got above 10% 4 times this year. And then you had that expansion over the last 2 weeks here when you got above or to 100. So that shows increasing number of strong uptrends because you're in a strong uptrend when you're hitting a 52-week high. And if you look at the high-low line, which is a cumulative measure of net new highs minus new lows, it rises as long as new highs outpace new lows. It's been rising since May 2nd, and it continued throughout 2026 to rise. So no signs of weakness within the S&P 500 internally. Now, if you look at the price chart, the S&P 500 has gone nowhere basically since October. Same with QQQ, the same with QQEW. It's gone nowhere, but it hasn't broken down. As far as my breadth indicators and long-term trend indicators are concerned, the S&P 500 is still okay. So what's holding up? Well, the low volatility end of the market is holding up because if you look at the US minimum volatility ETF, USMV, you can see that it has gone nowhere since May, granted that, but it's consolidated here. And while QQQ and QQEW moved lower in 2026. You can see this one has been moving higher, and it did tag a 52-week high there at the end of January and intraday here in February. And this is kind of a triangle consolidation, and it looks like we're breaking out. But clearly you're seeing some relative strength here in minimum volatility versus, say, the S&P 500, which is large cap weighted. And if you look at the indicator window, there's the PPO. You got a whipsaw there in April, but it's been bullish since the third week of April. You know, nothing exciting here. You're looking at minimum volatility for excitement. You're looking for something that is, say, an alternative to high beta. If you're looking for a place maybe to park some funds, to ride out the storm that's happening within the NASDAQ 100 and the tech sector right now. Now, what's interesting, if you look at the holdings in USMV, the top sector is technology, 27%. Then you got healthcare, financials, staples, industrials, utilities, 7.33%. So that's a pretty good weighting there. And they're also considered basically defensive. Healthcare is defensive. Industrial is one of the best performing sectors in 2026. In fact, let's look at the equal weight performance for these sectors. So here's a table showing year-to-date performance for the 11 equal weight sectors and the equal weight S&P 500 ETF RSP. And you can see there's RSP, it's up 3.65% year-to-date, whereas the S&P 500 is down about 0.63%, and QQQ is down 2.81%. So clearly the equal weight part of the S&P 500 performing much better than SPY and QQQ in 2026. And then if we rank the performance for these sectors here, we can see that energy is the best performing sector. Then we have materials, consumer staples, and industrials. All four of these are outperforming year to date. We can also see that we're seeing strength in utilities, REITs, healthcare, and then we get negative in technology. Equal weight technology is only down 0.86%, holding up much better than the XLK, which is the cap-weighted technology SPDR. It's down over 5% year to date. Financials dragging their feet, and communication services down 5.5% year to date. But the main point is here, despite the carnage we're seeing in software and cybersecurity and blockchain and some of these industry groups related to tech, fintech as well, the equal weight S&P 500 is holding up fine. The sectors, equal weight sectors, are holding up fine. And we had 100 new highs within the S&P 500. So it's not all that bad out there. So at TrendInvestorPro, we try to quantify a bull or a bear market using an array of breadth indicators. And we do that in two ways. We have a market regime page, which has charts based on stock charts indicators. And we do have a breadth market model for market timing. But you can see here, there's the market regime page. And as far as I'm concerned, we're still in a bull market. The nature of the bull market has changed. It started changing in late November when we saw the broadening happen with breakouts in industrials and materials and retail and banks. And that still remains the case right now. We're in the broadening trade. The tech trade is on the back burner. It's especially software and cybersecurity. They're in downtrends, blockchain's in a downtrend. But there are all alternatives out there, and that's what we're trying to find. And you can see in our reports this week, we highlighted a healthcare stock, a home builder, and a hospital operator with strong charts. And then when we look within the ETFs, we got the pop and drop in XLK, but I'm seeing setups in finance, healthcare, medical devices, housing, and even India. So check out TrendInvestorPro.com if you want to learn about the alternative that are outperforming and stay away from the ETFs that are underperforming. So I was looking at the components of the US minimum volatility ETF, the individual stock components. It's a very diversified ETF. The only thing it has in common is the stocks are quantified as low volatility relative to the other high volatility stocks. And so low volatility means less risk. It doesn't mean no risk. It means less risk. And also the more diversified you are, the more or the less risk you have and the more defensive you are, so to speak. And now if you look at the top 10 holdings and the performance year to date, they're all up. And if you look at these stocks, it's as old school as it gets. We got ExxonMobil leading the way. Then we got two healthcare stocks, Johnson & Johnson and Merck. And then we got the big insurer, Chubb. And then we got a holdover from the dot-com era, Cisco. Cisco is actually up 7% year to date and leading within the technology sector. Then we have Verizon, which is an old school telecom. McKesson, that's out of the healthcare sector. Duke Energy, utilities. And then waste management. You know, it doesn't get more consumer staple than putting out the garbage. So if you look at this as a very diverse group of stocks, but all 10 are up. And that shows you where the money is moving in 2026. It's moving into the less risky parts of the market and out of the riskier parts of the market. You can see that just by looking at Bitcoin. So I work under the assumption that a trend or a theme is in force until proven otherwise. And right now, the broadening trend is what is in force right now. That is the current theme operating in the market. And that favors sectors other than, say, technology and communication services. It's more in favor of industry groups like housing and retail and banks. And you saw these old school healthcare stocks. So healthcare is part of that. And I'd probably even throw in utilities because of their defensive nature. And that's what we'll be looking at in the coming weeks until this theme changes. So that's it for today's Chart Fix. Thanks very much for tuning in and have a great day.